All right, looks like we are now at 3:30. Hello, everyone, and welcome to the monthly market monitor for April. My name is Michael Ballman, investment analyst here at Corporate Central Credit Union. Thanks everyone for joining today. A couple housekeeping items to cover first. All microphones have been muted, so if you do have any questions as we go through, please feel free to use the Q&A feature or the chat feature to type any questions, and we'll be able to cover those at the end of the webinar. All right, so first we'll go ahead and start with an economic update. So first thing I wanted to cover today with everyone here is the new California minimum wage law as it relates to fast food workers. So this is something that took effect last week, Monday, April 1st. And for any of you, those of you that did see this headline, know this was not any sort of April Fool's joke. This is something that actually did get signed into law. So we'll go ahead and take a look at the key features about this and then take a look at maybe a little bit of what the impact on the economy might be. So first and foremost, what this did is this actually increased the wage on fast food workers in the state of California to $20 per hour. This does apply to any restaurants that have 60 or more locations nationwide. It does exclude types of restaurants that make and sell their own bread. So for whatever reason, they felt that that was an important thing to exclude those types of restaurants. One noteworthy point too is that the current minimum wage for California is at $16 an hour. One thing this also did is it created a fast food council. So what this is it's a makeup of industry representatives and workers. And a key piece that this council can do is they can actually increase the annual, or I should say, increase the wage on this on an annual basis up to 3.5%. And that is dependent upon things like, for example, inflation. So kind of digging into this a little bit. One thing this can certainly do is put some pressure on other restaurants that are not impacted by this. And so I mean is some of those mom and pop shops who, might not meet that 60 location minimum to require to increase to $20 an hour, but you might see some pressure by their employees to start wanting more higher wages, or they might leave to go to some of these fast food restaurants. That could lead to, again, closures for some of these restaurants and loss of job of those who maybe stuck around, didn't leave, jump ship, go over to these fast food restaurants. But again, it's going to put a lot of pressure on some of these smaller businesses in the state of California that might not have the capacity to pay $20 an hour for some of their wait staff. One thing this also does is it's going to put some pressure on the fast food restaurants themselves to find ways to cut costs and or reduce the impact of these new wages on their bottom line. So if you look like some of these corporate owned stores or locations, they can obviously push more automation into some of their restaurants. But if you look at some of these franchisees who might not have the backing of all this technology, they might not have access to some of this technology right away or at all unless they purchase some of these machines from those corporates. So obviously one alternative for these restaurants is to increase their prices, but as you know, we're coming off historically high inflation levels. And consumers can really only absorb so much of this before they start turning away from these types of restaurants completely. And in turn, this could lead to more shutdowns for the restaurants that ended up having to raise their prices to offset these higher wages. It also puts wage pressure on fast food restaurants who have employees that have been around for many years. So you think of some of these employees who've been around, maybe worked their way up to this $20 an hour amount that is now at the bottom. Some of these employees might start pushing for higher wages in turn to kind of give them a little bit of a advantage or more money for being around at these restaurants for longer. One thing this also does, it starts to take away some of these entry level jobs for some of the younger generations like high school students or college age kids. So you think, maybe some of you going back to, one of your first jobs, it might have been at a place like McDonald's, for example, where, you're working, figuring out what the labor force is all about, figuring out how to, do simple things, and essentially start to participate in that labor force. Some of that's starting to pull away and take some of those opportunities away. So you think of the long-term effects where, maybe they don't have a job until they're right out of college, if that's, their career path. Some of these, younger age kids might not have some of the job skills that you're expecting for someone that's coming out of college. So taking a look at all of that, let's kind of unpack and look at some of the economic impact this might have. So first, narrowing in on the state of California, obviously this took place in California, but this could push other industries within the state to start increasing their wages to get more toward that $20 an hour level. So you think back to the $16 an hour minimum wage that they're currently at in California. Some of these other industries, employees within those industries might start to push for higher wages. So you think of like a big, economy like California, is that going to have an impact on, say, things like inflation and things like that, unemployment? Maybe, maybe not. Obviously, that's one state, but with the size of California's economy, it could have a little bit impact, and we might start to see some of that trickle into our economic data. Again, that's to be seen. Maybe it doesn't have a big impact, but again, something to kind of keep in the back of your mind. One thing this could also do is create sort of a ripple effect across the fast food industry over, the entire United States. Obviously, this is maybe we'll call it a quote unquote test pilot for the state of California. And maybe other states might start to focus in on that. Maybe fast food workers across the country start to put pressure on their states to start increasing minimum wages. Maybe it's just the state's minimum wage. Maybe it's in the specific industry of fast food. But again, it's important to think about some of these things and really understand what's going on and how it could potentially impact, the rest of the country. So moving on from that, though, let's take a look at some employment data. So the unemployment rate for March saw a decrease to 3.8% from the 3.9% level that we saw in February. So again, you can see looking back to pre-pandemic levels, we're pretty much right in line, have a pretty strong labor force. Unemployment has been pretty low for the past several years. A good sign from the standpoint of, the labor market. Taking a look at the U6 rate for March, that remained flat at 7.3%. So again, no change there, but you can see that's been starting to trend up a little bit more. We're reaching levels, again, pretty much in line with pre-pandemic levels. But that's obviously something to keep your eye on. Is the labor market starting to, get a little bit weaker? That's, again, to me, remain unseen. Taking a look at initial jobless claims for the week ending March 30th. I was hoping to maybe include that first week in April to maybe catch some of those maybe layoffs that we're seeing in the state of California. It might include some of that. We did see a jump to 221,000 for the week ending March 30th, which was up from the prior week's 212,000. There might have been some layoffs or some closures, et cetera, that happened in that final week of March leading up to that change in April. So there might be some of that baked into those numbers, but it'll certainly be something to watch moving forward to see if there's any big impact on initial jobless claims. Taking a look at continuing jobless claims, those have been bouncing around over the past 2 years, but overall they have been slowly trending upwards. So again, more and more continuing jobless claims. For the week ending March 23rd, we were at 1.7 million continuing claims, which was down slightly from 1.81 million seen in the prior week. Taking a look at job openings now. Total job openings for February were at 8.76 million, which was up slightly from the 8.75 million that was seen in January. Since March of 2022, job openings have been trending in the right direction. You can see here at the top of the screen, the highest point there, March of 2022, we've been moving in a direction, to start closing some of those job gaps. But again, we're still elevated pretty high above where we were seeing pre-pandemic. kind of going back to relating to this California minimum wage law, it might be said, oh, maybe some of that will help fill the openings in these job gap. But I did take a little deeper dive into the job openings data. This comes from the Bureau of Labor Statistics. And I did highlight on here where that accommodation and food service industry stands as of the end of February at 927,000 openings. When you think about the state of California, are all 927,000 in the state of California? More than likely not. So is there going to be a significant impact? Again, going back to all of this data, probably not as much of an impact. But again, it's something to keep your eye on as we move forward in the future. I did highlight on here a couple of higher, industries that have job openings. One being the professional and business services at over 1.5 million openings. And then in this private education and health services, specifically looking at healthcare and social assistance, over 1.8 million job openings. Which is, when you look at the cost of healthcare, that's a little discouraging because over time, healthcare costs have been continuing to rise more and more over the years. And then you look at the number of job openings there, it's almost like you're paying more and getting less from your health service or your health plan. So again, not necessarily the most encouraging thing, but just something to, kind of point out here. Moving on from employment data, we'll take a look at retail sales. Retail sales increased at a 0.6% month-over-month basis for February after seeing a 1.1% decline in January. This did come in below market forecast that called for a 0.8% increase. If we break down some of the major sectors, we did see increases for building materials and garden equipment up 2.2%, motor vehicles and part dealers up 1.6%, electronic appliance stores up 1.5%, gas stations at a 0.9% increase, miscellaneous store retailers were at a 0.6% increase, food services and drinking places at 0.4%, general merchandise stores also at 0.4%, and then food and beverage stores at a 0.1% increase. Declines were seen at furniture stores down 1.1%, clothing down 0.5%, health down 0.3%, and then non-store retailers down 0.1%. Moving on, taking a look at the personal savings rate as a percentage of disposable income. That came in at February at 3.6%, which was down from the 4.1% seen in January. It appeared that the personal savings rate was starting to rebound after a turnaround in late 2022, but since then it has peaked in the spring of 23, and then you can see continuing to track down more and more as we move forward into the future here. So not necessarily great sign from a personal savings rate standpoint. Next, we'll take a look at some housing market data. So first, starting with housing starts. So housing starts for February came in at a seasonally adjusted annual rate of 1.52 million. This was about 10.7% above the revised January estimate of 1.37 million and is 5.9% above the February 2023 rate of 1.44 million. So, you can see been jumping around over the past several months, and right now we're kind of on that uptick as far as housing starts go. Taking a look at existing home sales for February, that came in at a seasonally adjusted annual rate of 4.38 million, which was an increase of 9.5% over January. This was the largest increase that we saw since February 2023. You can see that's the last really spike that we had in existing home sale prices. Since then, we've been, tracking back down. And again, something about, the beginning of the year here, in February, another spike in home sales. But again, looking at a year-over-year basis back to that peak of February 2023, existing home sales were down at 3.3% and continue again to remain well below pre-pandemic levels, that we saw before all the, craziness with the housing market during the pandemic. Taking a little bit deeper dive into existing home sales, look at some data from the National Association of Realtors in their February 2024 summary. Looking at the median price for existing homes, this did increase at a 5.7% year over year in February to 384,500. As you can see, the median price continues trending upward. You can see obviously different peaks and valleys along here, but that trend continuing to see rising home prices. Another noteworthy point here is that inventory of unsold existing homes did increase 5.9% on a month-over-month basis to 1.07 million in February, which is equivalent to about 2.9 months worth of supply at the current monthly sales pace. Taking a look at a breakdown of existing home sales by region, you can see that the South is still dominating most of the sales, making up about 46% of total sales in February. Again, followed by the Midwest, which was about a quarter of existing home sales. And then you can see the other two regions, the West and the Northeast, making up about 30% in total of all home sales, for existing home sales, I should say. These two regions continue to have the lowest median home prices, being the South and the Midwest, and are also seeing the smallest year over year increases in median home prices. So again, probably goes back to seeing most of the home sales coming in those regions because of those lower home prices. The median home price in the Northeast saw increases of 11.5% on a year over year basis in February, followed by a 9.1% increase in the West. However, like I said before, lower prices in the Midwest and the South. The Midwest saw a 6.8% increase in the median home price, and then the South saw a 4.1% increase on a year over year basis. And then just taking a look quickly here at the existing home sales by price breakdown. So you can see, obviously, that 100 to 250,000 range. Anything that is on the market, I'd imagine, is being sold up in there, but that did make up 20% of the sales. And then that 250 to 500,000 making up the majority. And obviously, you're moving up into higher and higher prices of homes. You're seeing less and less percentage of homes being sold in those price ranges. Taking a look at the percentage in sales on a year over year grouped by price range, you'll notice that there were increases in all price ranges besides the bottom two tiers of the 0 to 100 to 250. If you remember back to a few slides, we looked at total existing home sales and saw large spikes in both February of 2023 and February of 2024, but we didn't see as large of an increase in February of 2024. So in looking at this graph, we can see that the price ranges that most likely had an impact were these two bottom tiers that had actually saw a negative change in sales. And then we can probably draw conclusions from this that it more than likely, or I should say that it may not have necessarily been less demand in February of 2024, but more likely the lack of supply, particularly in these lower priced homes. And it's also safe to say that, if there were homes in these price ranges, this graph may have looked a little bit differently, people scooping up some of those homes, again, in those lower price range groups. Next, we'll take a look at some inflation data. So CPI did just publish this morning. So I did grab inflation data as of the end of March. So the annual inflation rate increased for the second straight month in March to 3.5% from 3.2% seen in February. This was the highest level that we've seen since September, and it also exceeded the forecast, calling for a 3.4% annual inflation rate. The consumer price index rose at 0.4% from February, which was above forecast of a 0.3%. And then the so-called core inflation, which strips out food and energy, remained the same from the prior month at a 3.8% level. Inflation remained steady for food at a level of 2.2%, which you can see is that light blue bar on the right side of your screen, as well as shelter at 5.7%, again remaining level. Increases were seen in energy costs, which is the dark blue bar that's on your screen there, which rose 2.1% versus a negative 1.9% in February, as well as gasoline increasing 1.3% versus a negative 3.9% in February. Transportation costs also rose at a 10.7% rate versus 9.9% seen in February. And then apparel was also up 0.4% versus a 0% flat level in February. We did see some declines in the automotive industry. So new and used vehicles, new vehicles decline at a rate of 0.1% versus a 0.4% increase in February. Used vehicles were decreasing at 2.2% versus a 1.8% decrease in February. So from the look of the used and new vehicle market, we might start seeing more and more prices continue to fall. Obviously, as more and more inventory might start coming onto those car dealers' lots. So unpacking some of this inflation data, what does it all mean? Well, if you look here, it almost appears though inflation is starting to stall out. And then if we look back to some of the prior graphs we also looked at, it seems as though the labor market continues to be in a strong position. And that very well might put a little bit of pressure on the Fed to continue to maintain rates at their current levels and maybe delay any sort of cuts that many have been anticipating for several months now. If inflation is starting to get more and more sticky at this, 3.5% level, again, they want to drive it down towards that 2% target rate. And that might mean, again, higher rates for a longer period of time. So I know we look at this screen almost every month on the monthly market monitor as of lately. Just a reminder, what it does is takes into account all Fed fund futures contracts being traded, and then it's calculating probabilities of moves at the upcoming FOMC meetings. So just taking a look at this one from Monday, you can kind of see where things were standing on that May 1st meeting. Very unlikely probability of a rate cut. But then if we fast forward to the WRP screen from today, you can see even less likely of a chance of a cut at that 2.6%. And then if you remember back to the prior screen, looking at that 9/18 Fed rate or the FOMC meeting date, it was at, if we go back, 1.5 cuts at a 64% probability. If we jump forward, it's down to now a 1 cut with a 48% probability. And then looking at that January of 2025 meeting, it's looking at, might be up to 3 rate cuts by that meeting at a 36.5% probability. But again, after, something like the inflation data comes out today, that cuts down to almost 2 cuts with a 32.8% probability. So one thing I think of when we're kind of looking at this screen, similar to like predicting the weather forecast, obviously it's hard to predict super far out into the future. And as you move more and more closer to some of these dates, it can, as the weather forecast can change so many times throughout that. Again, it's a good tool to use to see kind of where the market's predicting. But again, not necessarily something that we need to take with a lot of weight in some of our decision making. So next we'll move on to a little bit of market data, taking a look at the yield curve on a month-over-month basis. So on the graph here, that green line is this past Friday, and then the yellow line shows the prior month. So you can see not much change in the short end of the curve. If we look out towards the belly and then the long end of the curve, I've seen increases anywhere from about 15 to 25 basis points on a month-over-month basis. Jumping to the yield curve on a year-over-year basis, again, green line being last Friday, and then 1 year prior in that yellow line. You can see that 2-month rate, not as much of a change, but if you're looking at 1 month and then 2 all the way up to 30 years, looking at anywhere from a 95 to 105 basis points increase, depending on what tenor you're looking at. Next, we'll take a look at some market rates. And again, all these were pulled as of last Friday. Looking at the 2-year Treasury, we're down off of some of the peaks we saw a few months ago, but have been starting to trend back up to a level of 472 this past Friday. Taking a look at the 10-year Treasury, again, off its peak seen at the end of last year, but starting to trend back up to a level of 437. Overnight SOFR, that's been hovering around 532 since the last Fed rate. And obviously you can see here the hiking cycle that was taken by the Fed over the past several years. 1-month LIBOR, although this is not being used anymore, obviously as a benchmark or an index in any way, it is still being published as a quote unquote synthetic methodology. That is set to expire at the end of September this year, but again, something that we can still take a look at and track on an ongoing basis here. That's at 543 based upon the synthetic calculation. And then taking a look at 3-month LIBOR, again, at that same synthetic methodology, trading at about 555. Looking at the interest on excess reserves, that's been at 540 pretty much since the Fed paused hiking cycles. And then taking a look at the 30-year Fannie Mae commitment rate, that is down off its peaks that we're seeing about the fourth quarter of last year, but again, starting to trend back up to a level of about 630. And then finally, taking a look at the MBA refinance index, that has remained pretty much flat and below levels not only seen during the low rate environment over the past few years, but also, before the Fed started hiking, but also prior to pre-pandemic levels. Again, it just, not making much sense for people to refinance their mortgages with such high borrowing costs. So with there, if anyone does have any questions that you have not put into the chat yet, feel free to drop those in right now. I do have my contact information listed up here on the slide, as well as the contact information of the investments department. So if anything comes up after this that you think about, you want to discuss, feel free to reach out to myself or the investments department. Or if there's anything else that the investments department can do for you and your credit union, please feel free to reach out to us. We'd be more than happy to help out with that. I'm going to go ahead and check the QA and the chat feature here. Julie, are you seeing anything that I'm missing?
Nope.
Okay. Well, again, thanks everyone for your time here. Appreciate everyone. And then if today's inflation news, what is your best guess for the first rate cut? All right. Well, I don't necessarily want to predict any rate cuts. That's certainly something we can look at with, going back to, go back here. Whoops. Just based upon where the market's starting to look at, there's a chance again that, September there might be a rate cut, but again, that's at a 48% probability. So again, I don't necessarily like to use this as a predictor, more as a guidance as far as, this is what the market is looking at. So, I fortunately probably won't be able to necessarily give my crystal ball answer here, but, I do appreciate the question. Go ahead and check if there's any others. Lisa says, thank you. No problem, Lisa. Hope you enjoyed the webinar. There are not any other questions. We can go ahead and call this a wrap. Once again, I thank everyone for attending today, and we hope again to see you next month.